What I think we have, a global bust, as I define it, is something worse than what we've seen in post-World War II era. So in the last 80 years, it's not a depression. It's not going to last a decade. It's something that will be concentrated in a 12 to 18 month time frame. But it'll be worse than a typical recession, and it will come with a financial crisis that could be the worst in history.
And as for precious metals, I know you've been also very bullish on them. We've seen an increase along with the stock market with gold and silver over the last year or even longer than that. A huge gain last year, and this year started off very well for them. Where are gold and silver headed as the stock market continues its last leg up?
Yeah, I mean, silver's had a nice move today. Finally, it corrected this week.
Yep. And just to clarify for our viewers, we're recording this on Wednesday, March 5th. So
yes. Yep. Yeah. So, last week and earlier this week, we had silver down. But I want to remind people, because there's a lot of people who say silver's done nothing. Silver was at its bottom in 2020 was 12. In 2022, it got up to 18. It's now, 32 and a half, let's say. On its way to, I think next stop is 36. After that, probably the mid 40s. And then from there, I'm calling for 75. And these are all numbers for this year. I'm not saying it's, 2 years from now. Silver's okay. It's lagged gold. It has been a little frustrating of late because it came into this year. Basically, it's been flat this year. Flat to down, probably flat to down a little bit, and the miners have been big laggards. So that frustrates investors. But again, it's kind of good timing today because I really think we are seeing the turnaround in both the metals and the miners, and that we basically bottomed out yesterday. So I do think, and by the way, gold has done obviously much better than that. Gold's at all-time highs or very near all-time highs. I have a target there of 3,400 this year, and I wouldn't be surprised if I have to raise that somewhere down the road. But for now, comfortable with 3,400. It's still $500 away, and it's had a nice run. I mean, it's moved up from broke out at 2,100 a year ago or whenever, and you've had pretty much a steady gain all year, all the past year, and so. I'm very bullish. Probably my convictions are very high on the stock market having a final big run, as well as the metals having a big run here.
So it seems like definitely the run's not over, but this year you're expecting kind of the final or the really topping out here in a crash then in the stock market and precious metals.
Yeah, what I think we have, a global bust, as I define it, is something worse than what we've seen in post-World War II era. So in the last 80 years, it's not a depression. It's not going to last a decade. It's something that will be concentrated in a 12 to 18 month time frame. But it'll be worse than a typical recession, and it will come with a financial crisis that could be the worst in history, but certainly, comparable to 2008-9, and I think worse is why I'm calling it a bust, meaning bank failures all around the world. We cleaned up our act some in the banking area in 2008-9. I don't know. We're probably going to be better off than some of the rest of the world banking wise, but it's going to be a big enough unwind around the world that it'll hit our backs very hard too. So that's coming. I think it probably starts sometime, maybe fourth quarter this year, maybe sooner, maybe later, but somewhere in there. And as I said, we'll be moving towards a bust in terms of recession before that. If I were guessing, I'd say the top is by this summer in the stock market, but I don't know that. And what I expect to follow that is the biggest bear market we've had in the post-World War II era. I'm calling for an 80% peak to trough decline in the indexes. And so if you get an 80% decline or, 75, 80, whatever it is, that means you're going to, almost everything in the market's going to get hit across the board. The only asset that I think really will hold up in the bust are treasuries, and treasuries of all maturities, both T-bills as well as long bond. and everything in between. And that's because you have a government guarantee there and a guarantee from a government that people trust. So around the world, investors will flock to Treasury, U.S. Treasuries, because they don't know where else to go in terms of safety. So I expect the bond market to continue to rally while stocks are rolling over, while metals are rolling over, while most commodities are rolling over. That you could see a 0% 10-year rate at the bottom of the bust, or at the top of the bond market. And that could be late this year or early, first half of next year sometime. 0% 10-year. We got to 0.4, I think, in 2020, during the pandemic. This would be a new high in bonds or a new low in rates. Short rates probably go negative. And the reason for all that is because of, they're gonna be slow to catch on and slow to want to do it because they're not going to want to do what they did last time. They're trying not to repeat the same mistake. But when you're faced with a crisis that's, free falling financial system, you all of a sudden have to abandon whatever you think you should do, and they will be pouring money in at a rate we've never seen before. We could see the Fed balance sheet increase by 20 trillion. I mean, the Fed balance sheet got to 9 trillion a couple of years ago, last year, I guess, and early last year, and has shrunk down to maybe 7 now. Prior to, when we went into the 2008-9 decline, the Fed balance sheet was 875 billion. So we're now up to, got up to 9 trillion. I'm saying in this reaction to a bust, we could see 30 trillion in the balance sheet, an additional 20 plus. And every central bank around the world doing something similar, just because they don't have any other tool to deal with something that's basically free falling, not just markets free falling, actual banking system free falling. And I could be wrong on that, but that's where I think we're headed. If we get something less than that, it's still going to be bad. But that's kind of what I've been saying this for a while, as you know, that the end of this would end that way. In terms of the precious metals, they'll get hit hard, but not as hard as equities. Probably silver could get hit very hard. If we go to 75 on silver this year, it could easily come back to where we are now or lower. If gold goes to 3,400, 3,500, it could come back to the breakout at 2,100. I wouldn't expect much below that. So, you do the numbers and they're not as big as the equity markets, but still big, still don't want to suffer something like that. The difference between precious metals and equities is that post-bust, we'll have a cyclical bull market in equities, but they won't come close to the highs of this cycle. So, it's 7,500 on the S&P. Even if you go down 80% from 7,500, you're at 1,500. Even if you go up fourfold in a cyclical bull market, that only takes you back to 6,000. So you'll fall far short of the highs, the secular peak highs of this year. Silver and gold, on the other hand, silver's, I have a number at early next decade of 500, and gold maybe 20,000. So the next cycle is going to be very much a precious metal cycle, a commodity cycle. All the commodities will go through the roof simply because all that money printing, if they do indeed print 20 trillion, that will, with a couple year lag, start an inflation cycle that's bigger than anything we've ever seen here. We got 21% T-bills and 21% inflation back in the early 80s. I think we could see that surpassed easily in the early 30s and 2030s. So, it's a very extreme forecast, but we're nearing the end of a super cycle that's been in existence since the Great Depression. And that's what happens at the end of super cycles, is everything goes to extremes. So I think that's where we're headed.
Definitely things going to extremes. You mentioned how short-term bond yields could even go negative. Is that because there could be issues in the banking system? Because that doesn't necessarily make a whole lot of sense to me why people would, be fine with a negative yield. Why not just keep their money, doing nothing in the bank? But I could see if there were concerns about the safety of the banking system that it might actually make sense.
Yeah, it's the safety of the banking system. It's also if to do QE to expand balance sheet to the tune of 20 trillion. The Fed will be buying every treasury in sight, both long treasuries as well as short T-bills. They will buy everyone in sight, right? Because that's how you create money is you buy the treasury holdings that the commercial banks have, the dealer banks have. You buy those and you deposit cash or deposit dollars in the banks. That's how you expand the money supply. So they'll be buying everything in sight. And also, investors will be looking for the only thing, they'll be running to the treasuries as the only thing that has the government backing and government guarantee. So the demand will be through the roof. And even though the supply is going to be large, it's not going to be large enough to keep rates from going negative, I think. Now that's on short rates. On, like I said, the 10-year might get down to zero. We This all would sound ludicrous, except we saw it in 2020. Like I said, we got down to a 0.4 10-year. So zero's not that far from there. And this is going to be far more dire than what we saw in the pandemic. So, and corporate bonds will not follow treasuries. People have to understand not all bonds are created the same. Treasuries have a government guarantee, a government backing, explicit, right? Agencies have implicit backings, but the treasuries have explicit backing of the U.S. government. The government has the printing press through the Fed. So that's why that's viewed differently. If you're in a corporate bond, if you're in a junk bond, you're in trouble in that kind of a scenario. But if you're in even a single A, you may be in trouble. If you're in a triple A, depends on how bad things really get, but people are going to pay for that government guarantee. So the spread between even AAA and treasuries is going to get quite wide, and very wide between treasuries and junk bonds, as we saw back in 2008-9. So that's why really the only game in town will be treasuries.
Now, moving forward here, you mentioned how really precious metals in this next cycle are going to be the big winners as opposed to the stock market. When it comes to the short-term gains we might see in the next couple months, we can't give financial advice, and really you're just giving a forecast here. I know you have mentioned in the past that it's really, I guess, this last leg of this 42 or 43 year bull market is really a risk on phase where it's high upside, but also, or maybe not even that high upside, but very big downside potential. So is there a cautionary warning to investors right now, or what is your perspective on people invested in, the stock markets or even gold and silver right now?
Yeah, you have to, those numbers I've been throwing around, you have to understand yourself. And on the one hand, we're looking at probably the fastest returns in a market over the next 3 to 6 months. If I'm right that the Russell can go up 50 or 60%, and the Nasdaq 40%, and the S&P maybe 30%, Dow 30%, to have all that happen in 3 or 4 or 5, 6 months, that's huge returns that you normally have to work hard to get over 3 years maybe. To have a double-digit gain 3 years in a row is pretty good for most investors, right? And so it's easy, like right now, for people to say, I don't care what's coming, what Trump's doing, or what's going to happen with the economy. I can't afford to lose money. I'm getting out now. I just caution people, people have to do what they're comfortable with, and what their risk aversion tells them to do. But just caution and know yourself. If you get out now and the market runs 30, 40, 50%, I can almost guarantee you that the majority of investors will be pulled back in, because that's how psychology works. And investor psychology is one of the most powerful emotions, if not the most powerful emotion on earth. And if you're missing a market like that, somewhere along the line, you're going to jump back in and say, well, I don't know that it's going to top. Wall Street's telling me we got 3 years to run before this thing tops. So you're going to end up getting out now, missing the bulk of that move, getting in at the top or near the top, and then riding down, the market, maybe all the way, maybe halfway, whatever. Everybody will be different. But so I just tell people, know yourself, know what investor psychology is like. And I can't advise people whether they be in now or be out now, or, when to get out. But just understand, I lay out what I think is coming. I don't have a crystal ball to know for sure, but what I think is coming. And if it plays out very close to what I'm talking, just know there's a lot of short-term returns here just ahead. Even though most of Wall Street's telling you it's time to get out, they get it wrong. When the crowd is telling you something, often they get it wrong. Most of the time they get it wrong. And right now the bearishness is very high. On the other hand, what makes this such an unusual period is that within months, we're talking about the biggest bear, if I'm right, the biggest bear market we've had in 90 years. And you certainly don't want to just sit and say, I'm a buy and holder and ride through that. I mean, it'll be the rare investor who's going to be happy that they, listened to the buy and hold crowd and stayed put and then lost 80 or 90% of their portfolio, their wealth. So just know, yes, you got some big returns just ahead, but there's also some huge risks just over the hill, just over the mountain. And again, I'm giving you what I think. I've got a pretty good track record, but I'm not perfect and I can be wrong. So you have to kind of make that decision for yourself, but also just kind of understand it's one of those things where you're running up the mountain and running down it. And if you don't understand how easily psychology can pull you back in, getting out too soon here could lead to even worse mistakes for you on the other side. And then the big story is beyond the bust and beyond that bear market, there is plenty of opportunity. It's just not going to be the same opportunities you saw in the last 15 years. Cycles change. Every cycle has different leadership. This last cycle has obviously been a very big tech cycle, and up until recently a healthcare cycle. The next cycle is going to be a huge commodity cycle. The commodity producers, commodity stocks will lead the market, and that includes precious metals, but also copper, nickel, every commodity, steel, all the commodities I think are going to go through the roof because of that huge money that gets printed. What happened is you spent decades rationalizing down capacity, saying, well, we're, just-in-time inventories and, commodities are, we can manage them more efficiently now. So, and plus, there was a move against, for environmental reasons, against mining, against oil drilling, etc. So what we have now is commodity production that can, fits the demand cycle now. But if you get this ramped up demand through the roof in the second half of this decade and into early next, you're going to have huge demand and limited supply, and that's why prices can go through the roof. So, for example, copper, which is, say, $4 now, can go to 20 or higher. Natural gas, which is maybe $3, can go to who knows what, 40, 50, who knows, because demand will go through the roof. And you can say, well, there's a lot of supply as natural gas. And, that's crazy. You'll be amazed how fast that supply gets eaten up in in a very monetarily driven, commodity driven, industrial driven cycle. And that's what I think we'll have second half of this decade.